Hello, everyone, and welcome to Financial Accounting. Today, we continue with the topic called the accounting cycle, capturing economic events. We will look at the owner's equity accounts, such as revenue, expenses, and dividends, and learn how and when transactions involving those accounts should be recorded. We will also look at the trial balance and how it is prepared. Make sure to watch the video where we discuss the rules of debit and credit in great detail. I'm posting the link right here and in the description box of this video. Owner's equity includes capital stock and retained earnings. The retained earnings account represents all the accumulated earnings of the company since inception that haven't been paid to owners. In other words, the retained earnings account includes revenue, expenses, and dividends. Net income is the excess of revenues earned over expenses incurred. It is not an asset. Net income increases owner's equity by increasing retained earnings. When a company earns income, assets must increase or liabilities must decrease to reflect the earnings process. For example, when a company rendered services to its customers and received cash in return, the asset account cash is increased, and so did the owner's equity account retained earnings. Let's say a company renders services and receives 1,000 cash for its services. The accounting equation is going to be 1,000 in assets equals to 1,000 in owner's equity. If the company receives cash in advance and records it as unearned revenue, which is a liability account, it decreases the liability account once services are rendered. Again, let's look at the accounting equation. When we plug the numbers into the accounting equation, we have 0 in assets equals to minus 1,000 as liabilities decreased and plus 1,000 in owner's equity as owner's equity increased. The accounting equation balances. Net income always represents an increase in the owner's equity of a company. Here is the income statement of JJ's Lawn Care we prepared in one of the previous lessons. Remember that unlike the balance sheet, the income statement needs to be prepared for a period of time. In this case, it's for the months ended May 31st. Business operations are divided into arbitrary time periods in order to provide timely and meaningful information to users of financial statements. Usually, financial statements are prepared monthly. However, many transactions cross from one accounting period to the next. This creates a problem for accountants. To deal with this problem, we will be using accrual accounting. Revenues represent the price of goods sold or services rendered to customers during any given accounting period. Revenues increase owner's equity. Expenses are the cost of goods or services used up in the process of earning revenue. Accountants try to match expenses incurred with the revenues generated in an accounting period. Expenses decrease owner's equity. One of the basic concepts of accounting is that revenue should be recognized when goods or services are sold to customers. Most people are cash-based, so this concept may take some time to understand. If cash basis of accounting is used, revenue is recognized when cash is received rather than when it is earned. Likewise, expenses are recognized when paid rather than when incurred. The matching principle states that we must match expenses with the period in which they are used. The policy of recognizing revenue in the accounting records when it is earned and recognizing expenses when the related goods or services are used is called the accrual basis of accounting. The goal of accrual accounting is to measure the company's profitability during the accounting period. Revenue is offset with all of the expenses incurred in generating that revenue, thus providing a measure of the overall profitability of the economic activity. Let's take a closer look at recording revenues and expenses. Remember, we discussed that net income increases retained earnings and owner's equity. Since net income is an excess of revenue over expenses, we can conclude that revenues increase owner's equity and expenses decrease owner's equity. A decrease is shown in owner's equity with a debit. Increases in expenses must be recorded as debits in a separate ledger account. An increase in owner's equity is shown with a credit. Increases in revenues must be recorded as credits in a separate ledger accounts. Usually, companies have separate ledger accounts for the most commonly used revenues and expenses. We previously learned that payments to owners decrease owners' equity. In turn, investments by owners increase owners' equity. Dividends are payments to owners of a corporation. An increase in the dividend account is shown with a debit. Capital stock represents investments by owners of a corporation. An increase in the capital stock account is shown with a credit. Let's look at recording revenues, expenses, and payments to owners of JJ's Lawn Care. Let's first review the transaction where JJ's Lawn Care provided services to customers and received $750 cash. The asset account, cash, increased by $750. An increase is shown in an asset account on the debit or left side of the account. The revenue account, sales revenue, increased by $750. An increase in the revenue account is shown with a credit. The amount is placed on the credit or right side of the account. If you are unsure whether a debit or credit must be used to record revenue, always start your transaction with cash. The rules for cash are easy to remember. We also know that debits are always equal to credits. If you recorded a debit to cash, you know that the second part of the transaction is going to be a credit to revenue. Let's look at the next transaction. JJ's Lawn Care purchased gasoline for the riding mower and truck, paying $50 cash. This will be a transaction that includes a separate expense account. The asset account, cash, will decrease by $50. The decrease will show on the credit or right side of the cash account. The gasoline expense account increased by $50. Increases in expense accounts are shown as debits. The $50 increase in gasoline expense is shown on the debit or left side of the ledger account. Let's look at one more transaction. On May 31st, JJ's Lawn Care paid a dividend to its owners in the amount of $200. The asset account, cash, decreased by $200. The decrease is shown on the credit or left side of the ledger account. The dividend account increased by $200. The increase is shown in the dividend account with a debit of $200. Remember, dividends reduce total owner's equity. Let's take a first look at the trial balance. The trial balance is a report run at the end of an accounting period. It lists the ending balance in each general ledger account. The report is primarily used to ensure that the total of all debits equals the total of all credits. It means that there are no unbalanced journal entries in the accounting system. Having unbalanced accounts would make it impossible to generate accurate financial statements. It is important to note that a trial balance is not a financial statement. Let's take a look at the unadjusted trial balance of J&J's Lawn Care Services as of May 31st. Remember that all transactions have an equal debit and credit impact. The total debit balance should be equal to the total credit balance according to the rules of double entry bookkeeping. The total of the debit balance accounts is $21,900. This is exactly equal to the total of the credit balance accounts. This means that the books are in balance. The accounting cycle is viewed as an efficient means of introducing basic accounting terms, concepts, processes, and reports. This is just an introduction to accounting. Accountants spend much of their time focusing on more analytical aspects of their discipline. Thank you for watching this video. I hope you found it helpful. Don't forget to like and subscribe so you don't miss future videos. I will see you soon.